Look, I need to tell you something that most people in finance won't say out loud. Diversification is dead. I know that sounds crazy. I know it goes against everything your financial advisor has ever told you, but I've spent 35 years studying macro cycles, running hedge funds, working at Goldman Sachs, and building real vision. And the data is screaming one thing right now. If you own more than two asset classes in this environment, you're doing it wrong, and I'm going to show you exactly why. Before we go any further, subscribe and hit the notification bell. What I'm about to share is the framework I use to manage my own money, the same framework that's guided my investments for the past decade. This is the stuff institutions pay hundreds of thousands of dollars for. Now drop a comment. What percentage of your portfolio is in these two assets? I want to see where everyone stands. The Everything Code. Let me start with what I call the Everything Code. This is the macro framework I've developed over 30 years of studying markets, and once you understand it, you'll never look at investing the same way again. Here's the core insight. There's only one thing that drives asset prices, one thing, and it's not earnings. It's not fundamentals. It's not even innovation. It's liquidity. Liquidity is the master switch of all financial markets. When liquidity expands, asset prices go up. When liquidity contracts, asset prices go down. It's that simple. I've run the correlations. Bitcoin has a 90% correlation with global liquidity. The Nasdaq has a 95% correlation. It's hard to refute that this is not what is happening. So the question becomes, where is liquidity going? And the answer is up, way up, for the next 18 to 24 months. Let me explain why. The debt refinancing tsunami. Here's what nobody is talking about. Since the 2008 financial crisis, governments around the world lowered interest rates to zero and issued massive amounts of debt. But here's the key: most of that debt was issued with maturities of 3 to 5 years. What does that mean? It means every 4 to 5 years, there's a massive wave of debt that needs to be refinanced, and when governments refinance debt, they need to inject liquidity into the system to make it happen. I originally thought the crypto cycle was 4 years, but I've extended it to 5. Why? Because I found that in 2021 and 2022, many countries extended their debt maturities beyond 5 years. This means the liquidity surge everyone expected in 2025 has been delayed to 2026, and here's the number that should blow your mind. $10 trillion of global debt needs to be refinanced in 2026. $10 trillion. When that happens, central banks will be forced to pump liquidity into the system. They have no choice. It's refinance or default, and no government chooses default. This is why I believe we're entering what I call the banana zone, the phase of the cycle where asset prices go parabolic. But here's the thing. Not all assets will benefit equally. The hidden tax you don't see. Let me explain something that most people don't understand. You're being taxed 11% per year and you don't even know it. Here's how it works. Global liquidity is expanding at about 8% per year. That's currency debasement. Your dollars, your euros, your yen, they're losing purchasing power at 8% per year just from money printing. Add in another 3% for reported inflation. That's an 11% hurdle rate on any investment just to break even. If your portfolio isn't returning more than 11% per year, you're actually getting poorer. You're going backwards. Your wealth is being transferred to people who own scarce assets. This is why real estate keeps going up. This is why stocks keep going up. This is why gold keeps going up. Scarce assets absorb the liquidity. They protect you from debasement. But here's the problem. Young people can't afford real estate anymore. Stocks are expensive. Gold doesn't compound. So what's the answer? There are only two assets that can consistently beat the 11% debasement hurdle over the long term. And those are the two assets I'm telling you to own. Asset number 1, Bitcoin. Let me be very clear about this. Bitcoin is not a speculation. Bitcoin is not a trade. Bitcoin is the greatest macro trade of all time. Here's why. Bitcoin has returned an average of 150% per year since its inception, even accounting for the brutal bear markets, even accounting for the 80% drawdowns. The long-term compounded return crushes every other asset class in existence. Nothing else comes close, but it's not just about past returns, it's about the structure of the asset. Bitcoin has a fixed supply of 21 million coins. That's it. No more will ever be created. While governments print trillions of dollars, while central banks debase currencies at 8% per year, Bitcoin's supply remains absolutely fixed. It's the hardest money ever created by humans. And here's what most people miss. Bitcoin is not just a store of value. It's a network, and networks follow Metcalfe's law. The value of a network grows exponentially with the number of users. Right now, Bitcoin has roughly the same user adoption as the internet had in 1997. We're still early, incredibly early. If Bitcoin simply matches gold's market cap of $15 to $20 trillion, we're looking at 5x to 7x from current prices. If Bitcoin becomes the global reserve asset that absorbs a portion of the $100 trillion in global bond markets, we're looking at prices most people can't even comprehend. My base case. Bitcoin hits $300,000 to $450,000 in this cycle, maybe more if the cycle extends into 2026 as I expect. But here's the key, you have to be able to hold through the volatility. Bitcoin regularly pulls back 30% to 40% even in bull markets. We've already had 20% plus corrections. In this cycle alone, that's not a bug, that's a feature. That volatility is the price you pay for asymmetric upside. If you can't handle watching your portfolio drop 35% temporarily, you shouldn't own Bitcoin. But if you can stomach the volatility, if you can think in years instead of weeks, Bitcoin is the single best asset to own in a world of infinite money printing. Asset number 2, Solana. Now here's where it gets interesting. If Bitcoin is digital gold, Solana is digital real estate in the fastest growing city in the world. Let me explain. Bitcoin is a store of value. It's the pristine collateral layer of the crypto ecosystem, but Bitcoin doesn't do much. It just sits there and appreciates. Solana is different. Solana is a high-performance blockchain that actually does things. It processes transactions, it runs applications, it hosts DeFi protocols, ENFTs, payments, gaming, all the activity that's being built in crypto. And activity means adoption. Adoption means users. Users mean value. Here's what the data shows. Solana's user growth is faster than Ethereum's was at the same stage of development. The network is processing more transactions than Ethereum at a fraction of the cost. Developers are building on Solana because it's fast, it's cheap, and it works. I've run the models. Each new user on Solana adds approximately $65,000 in network value. As adoption grows, that value compounds. Now, Solana is higher on the risk curve than Bitcoin. When Bitcoin pulls back 30%, Solana pulls back 50% or more. That's just how risk works in crypto, but the upside is also higher. I expect Solana to outperform Bitcoin for the rest of this cycle, and I expect it to significantly outperform Ethereum, which has been losing market share and mind share. My portfolio allocation. I'm heavily weighted toward these two assets, Bitcoin for the store of value, Solana for the growth and adoption play. That's it, 2 assets. Everything else is noise. What I'm not owning, let me tell you what I'm selling, what I'm avoiding, what I think is a waste of capital in this environment. Traditional stocks outside of tech. Most stocks can't beat the 11% debasement hurdle. They return 7%, maybe 8% per year on average. That's going backwards in real terms. Bonds. You're lending money to governments that are actively debasing their currencies. You're guaranteed to lose purchasing power. Bonds are return-free risk in this environment. Most altcoins. There are 15,000 cryptocurrencies out there. Maybe 20 of them will survive long-term. The rest will go to zero. I'm not smart enough to pick which small caps will make it, and neither are you. Stick with the majors. Cash beyond what you need for emergencies. Cash is losing 11% per year to debasement and inflation. Holding cash is a guaranteed loss. Keep what you need for living expenses and emergencies, but don't hoard it. Gold. I know this is controversial. Gold has been money for 5,000 years, but gold doesn't compound. Gold doesn't have network effects. Gold can't be transported at the speed of light. Bitcoin does everything gold does, but better. I'd rather own Bitcoin. Look, I'm not telling you to be irresponsible. I'm not telling you to put your rent money into crypto. Position sizing matters. Risk management matters. But if you're trying to build wealth over the next 5 to 10 years, you need to own the assets that benefit from liquidity expansion and currency debasement. And right now, those assets are Bitcoin and Solana. Now let me give you the framework I use for actually managing this portfolio. I call it the don't FCAC this up thesis. The goal is not to maximize returns. The goal is to avoid catastrophic mistakes that destroy your portfolio. Here are the rules. Rule number 1, no leverage, ever. I cannot stress this enough. Leverage is the killer. Crypto is already volatile enough. Adding leverage is how you get liquidated. It's how you lose everything. Don't do it. Rule number 2, focus on the majors. 80% to 90% of your crypto portfolio should be in Bitcoin, Ethereum, and Solana. These are the assets with real adoption, real network effects, and real staying power. They won't go to zero. The other 10% to 20%. That's your degen bag, the small speculative bets that might 10x or might go to zero, but limit it. Don't let speculation consume your portfolio. Rule number 3, have a long time horizon. Think in cycles, not in weeks. The crypto cycle is now 5 years, not 4. If you're going to invest, plan to hold until at least 2027 or 2030. Short-term volatility is just noise. Rule number 4, expect 35% drawdowns. They're coming, they always come. Even in bull markets, crypto pulls back hard. When it happens, don't panic, don't sell. The people who sold in the 2020 COVID crash missed a 10x rally. The people who sold in the 2022 bear market missed another 5x rally. Pullbacks are opportunities, not disasters. Rule number 5, avoid FOMO. There will always be a new shiny token, a new narrative, a new thing everyone is talking about. Most of them will fail. Stick to your thesis. Stick to your plan. Don't chase. This framework sounds boring. It's not exciting. It won't make you rich overnight, but it will keep you in the game long enough to benefit from the compounding effects of being right about the macro thesis. And the macro thesis is simple. Liquidity is expanding, and scarce digital assets will absorb that liquidity. The minimal regret portfolio. Let me introduce one more concept. I call it the minimal regret portfolio. Here's what it means. When you look back at your investment decisions in 5 years, you don't want to feel like an idiot. You don't want to regret panic selling at the bottom. You don't want to regret going all in on some meme coin that went to zero. The minimal regret portfolio is designed so that no matter what happens, you can live with your decisions. If crypto moons and you're holding Bitcoin and Solana, you'll be happy. You won't have the absolute maximum gains, but you'll have captured most of the upside. If crypto crashes and you're holding Bitcoin and Solana, you'll survive. These networks aren't going to zero. They'll recover in the next cycle. You can wait it out. If you were diversified across 50 random altcoins and half of them went to zero, that's regret. That's a decision you'll torture yourself over 4 years. The minimal regret portfolio is concentrated in high conviction, high quality assets. For me, that's Bitcoin and Solana. Why this is the greatest opportunity of our lives. Let me zoom out and give you the big picture. We are living through the greatest wealth transfer in human history. Governments are printing money at unprecedented rates. Currencies are being debased at 8% per year. Traditional savers are being wiped out. People holding cash, bonds, and low-yield investments are going backwards. Meanwhile, people who own scarce assets, real estate, equities, crypto, are seeing their wealth explode. This isn't fair, it's not right, but it's reality. You can complain about it, or you can position yourself to benefit from it. I choose to benefit. Crypto is a $3.5 trillion asset class right now. My models suggest we could reach $100 trillion within the next 10 years. That means we've only covered about 3% of the journey, 3%. The opportunity in front of us is staggering, and it's being handed to us on a silver platter because most people still don't understand what's happening. They think crypto is a scam. They think it's too volatile. They think they missed it. They're wrong. The cycle is extending into 2026. Liquidity is about to explode. $10 trillion of debt needs to be refinanced. Central banks will be forced to print, and when they print, crypto goes up. It's that simple. Final thoughts. Let me be very clear about something. I am not giving you financial advice. I don't know your situation. I don't know your risk tolerance. I don't know your time horizon. What I'm sharing is my framework, the way I think about markets, the thesis that guides my own investments. You need to do your own research. You need to make your own decisions. You need to size your positions appropriately for your own situation. But here's what I believe with high conviction. The next 18 to 24 months will be the most important period for wealth creation in our lifetimes. Liquidity is coming. The cycle is extending. The macro setup is as good as I've ever seen it. And there are only 2 assets I want to own: Bitcoin and Solana. Everything else, sell it. If this video gave you a new perspective on how to think about your portfolio, hit that like button right now. Subscribe if you haven't. Turn on notifications. This is the kind of macro analysis that most people never get access to. I'm giving it to you for free because I believe financial education should be available to everyone. Drop a comment and tell me, are you concentrated or diversified? Do you own these 2 assets? What's holding you back? The opportunity is here. The setup is complete. The question is, will you take it? I'll see you in the next one.